I'm Colby McFadden, and for the last 2 decades, I've worked with some incredible families and individuals, helping them manage their investments and finances. I'm a father of 2 daughters and recently a grandfather of 2 granddaughters, and it really got me thinking about what resources are there for women to find a trusted, reliable source for investing and savings. So I reached out to Kristen Yoder, a good friend for years and somebody I've really appreciated their ability to call out BS. And I asked her if she'd like to work on a project where we could create a trusted resource where women could turn to learn about savings and investing.
Hi, I'm Kristen Yoder. I'm a 16-year Los Angeles cannabis industry veteran and host of the Cannabis Detector podcast. My co-host and I have collaborated on a series of episodes focused on investing in cannabis in the past. So when he approached me about doing a podcast focused on helping women build confidence in their money management skills, I jumped at the opportunity.
Hello, and welcome back to the Confidante Investor podcast. I am here with my confidant, Colby McFadden of Quiver Financial, and we are getting into analysis this week because we were going through FOMO before.
Hopefully not paralysis.
Yeah.
Hopefully not paralysis by it.
Which is definitely a problem of mine, but I have been taking some short LinkedIn classes and also paper trading on Webull, and I'm working on my money muscle as I read somewhere, and now it's Reddit is not the only place I should be getting my information from, and I feel being FOMO investor in crypto and buying at the peak, and now everything ate shit, essentially. It's Colby, now I need to learn how to do some technical analysis. And Webull made me feel like I don't know anything, bro. I am, my brain is floating. I don't get it, dude. So,
there's a lot on there.
Yeah, it's so much. But as we talk and as I'm learning, there's something to analysis that is super important. So I'll let you take it from here.
Yeah, I mean, in the last episode, we really got into this whole FOMO thing because it's palatable right at this current moment. And, there's tools that we can use to protect ourselves from some of the emotions that get involved. And that's what we do. When on the professional side of the business, it's all about managing emotions. Because it's a very counterintuitive business, is that the best opportunities is when emotions are high. And that's typically when times are tough. And if you want to buy low and sell high, you got to be used to deploying capital when nobody else wants to, and taking profits when nobody wants to take profits. So what we'll go over this a little bit of comparison between fundamental analysis, technical analysis, how to use them as a way to avoid FOMO, and then also just manage the risks of when you get into a position or into an investment. So I'm going to share a few things here.
Yeah, so we highly recommend, if you listen to the audio, that you check out YouTube because this is a very visual episode. And there was something you mentioned to me last week, and you're like, well, look at the reversion of the mean. And I'm like, what the fuck are you talking about, bro? That is I don't understand, So, but now I get it. I understand because you showed me, and also in my little classes that I've been taking. I mean, the mean is the average. And so what you're about to talk about gets into that better.
Yeah, because everything, life is great in the sense that whether it's financial markets or your health or your mental health, whatever it may be, everything's about balance. And markets, financial markets, are part of nature. If you think about it, what happens in financial markets is just a conglomeration of people making decisions. It's a living organic thing because it's, at the end of the day, it's people. Even though there's algorithms and this and that, there's still people in there and emotion. And so there's ways that you can really track that through analysis, and understanding fundamental and technical analysis really helps. And reversion of the mean is one of those things that helps keep everything in balance. And I've just found over my career to always look for it. So let's start by talking a little bit about what fundamental analysis is, because essentially fundamental analysis is what we've been doing up until this point. Learning about your money personality is part of fundamental analysis. When we talked about building the structure of a portfolio and saying, hey, let's pick the sectors that have the greatest amount of relative strength. Essentially, they have the greatest rising tide. That's part of fundamental analysis. So when you're doing fundamental analysis on a company, like this would say, is you're doing the analysis on their financial statements, their assets, their liabilities. So there's that aspect. And then there's this broader fundamental analysis where you're looking at the overall state of the economy and factors like interest rates and earnings and employment levels and GDP and what's going on in housing and manufacturing, and are we in a bull market or in a bear market? So those kinds of questions are the fundamentals that should be used to help you identify opportunities, right? So the fundamentals are, hey, what looks like is a good place for me to go get invested. So we can see that there's a trend in plant-based medicines. So there's a fundamental story there. We can see that there's a trend in alternative energy. Go ahead.
With that said, would fundamentals also take into consideration what you have a strength and knowledge in? Because my knowledge base is in alternative medicine, cannabis, essentially, which is also an agricultural commodity, which touches on renewable energy, because, you know, depending on if you're growing indoors or outdoors, these type of things impact, you know, your energy output and how much it affects the power centers, etc. Like, is that something people should consider when they're starting to look into what they're investing is? Looking into something that they already have knowledge in, and not just what seems to be doing really well because things ebb and flow?
Absolutely. Yeah, that's part of aligning things with your money personality and your level of knowledge. And that's also, we had talked about in the first or second episode about how you stay interested in things, is that you have a high level of interest in something. That, you know, should become like a hobby that keeps triggering your, oh, I want to know more muscle. And so, yeah, fundamental analysis, and where you're benefiting, and where I think you have an advantage over a lot of people, is your interests are in areas that have some fundamental trends. There's already some fundamental trends happening in ESG and plant-based medicines and ag tech. So those are all, you know, naturally, just because of where your interests are, you're finding that you're probably landing into some areas that already have some pretty good fundamental structure to them. So that's a great first start.
Yeah.
So that, you know, fundamental analysis, hey, where do I get started? You know, where do I put my money? Where's the opportunities is basically what the questions are behind there. And then if that leads you to starting to deploy capital or investing in positions, then I highly recommend people learn as much about technical analysis, because this is a methodology that helps you possibly forecast the direction of prices. And you're really doing a study of charts and price and volume. And then you can bring in things like behavioral economics and quantitative analysis, because they all tie in as tools that help you manage risk. Once you've fundamentally decided where you want to put your money to work, then once you're there, you can start to use charts and technical analysis to decide, oh, where do I add more money? Where do I take profits? Where do I just sit still and do nothing?
Yeah, I think, you know, when it comes to technical analysis, when I decided to give into FOMO on my crypto investments, it would have been good to look at charts to see, like, they are way out of the mean. Like they're nowhere near where they usually are. And that would have been a hint that like, yo, this is not sustainable. Like this is not a good time to invest. Like wait for it to dip, because it was the people that bought before the peak that are better off. And when you buy at the peak, like you don't get the money back. Like you're just like trying to catch up or like, and I must say, I have been addicted to going between my different apps. Like looking at them, I swear to God, like an hour at least a day.
It's as bad as social media. You open it and go, I just looked at it 10 minutes ago, close it. Oh, geez, like, get away, bro. Yeah,
but it's
absolutely.
also funny because I read somewhere that the best portfolios are owned by dead people. And that's because they don't keep moving stuff. Like when you invest, this is why you analyze, is because, I mean, with capital gains tax, etc., the point is when you invest, it's on a longer basis than at least a year for the tax reasons alone. And so when you showed me these charts that we're going to look at, it's very clear that this is a crazy time in the capital markets to be investing or anything. I mean, people are winning, and like people are going to lose a lot too if they're investing right now. And I'm glad that I have a perspective to see that like, maybe it's not the best time to buy into everything, because it's not sustainable.
Rule number one is avoid losses. And the reason being is people forget that, if you take a 50% loss, you now have to have 100% gain to get back to even. It's not easy to get 100% gain, right? That doesn't happen overnight. It happens over years usually. So if you can avoid, even if you lose 20% of your money, it takes something like 28 to 30% return to get yourself back. So just realize, if you can avoid losses or keep them to less than 5%, then you can recover from those. Are like paper cuts. You want to view it as, hey, I can handle a paper cut. I can't handle a cut of an artery. And if you do your fundamental analysis right, that'll eliminate a lot of that from happening. If you do your fundamental analysis right, then you should be really looking for areas of adding to positions and only looking for areas to get out of the position if the overall macro view turns. Like, for instance, in a year like 2008, when it was just everything was losing for a whole year and a half, it didn't matter, what the fundamental analysis was. It was just stay away. So occasionally you have times like that, but outside of that, 90% of the time, what we're going to cover works. Okay. So
let's cut to a break and then come back real quick. Okay. Okay, we're back.
All right. So the first thing that I always like to do is remind everybody of the denial panic continuum to the point of ad nauseum. And the reason being is part of that fundamental analysis is understanding where are we in the general picture, is the overall market. Because here's an example. I sat next to somebody a couple of weeks ago that was very smart but inexperienced, and they were trying to argue the point that even if the stock market goes down, that XYZ company won't go down because they have a unique story. And what he was talking about was Airbnb. He was saying, hey, even if the stock market goes down, I think Airbnb has a great model and they're going to do just fine. And I had to remind the person that, but if it's a stock inside a stock market and that whole market is going down, it's going to affect that stock, even if it's got the greatest story. So it's really important to always step back and say, okay, is the overall market, is the general market in a position of thrill and euphoria, or is it in a position of depression, despondency, hope, relief, whatever it may be? And this is up to everybody's own individual analysis. I have my opinion of where we are. I also am very visual. So I start this process by always looking at a very long-term chart, because when you look at things, just like in life, when you look at things from a long-term view and you judge people and things on the balance of their work, you find the reversion of the mean, or you find the balance or the middle line And that's where I do know nature works. And I've seen markets over 25 years when they go parabolic, like, and what we're showing here is a chart of the S&P 500 over a very long period of time, 30 plus years. And the reason I want to start there is because I want to ask the question of where's the mean? Where's the balance of this market? Because it sure does feel euphoric. And Kristen, from the viewpoint of this, what do you think? I mean, what's your feeling of something that has a straight line?
Yeah, this makes me feel like, no, I'm gonna hold off. I'm gonna wait. This makes me feel like we are at a historical euphoria right now. And it also makes me, as a BS detector, wonder, like, what kind of corrupt shit is happening in the financial market this time? Because before it was the mortgage crisis and all of the things that they were doing with the mortgage refinancing and everything, and then that tanked the housing market, which tanked tons of things and like ruined all these banks. That this makes me very skeptical of like something is not right, dude.
Perfect. Well, good, because that's a good contrarian nature. And I will tell you, when you see something that is away from the mean, so the question is, okay, well, what do you mean, Colby? Show me the mean by visualization. And you can do this analysis on an index like this. You can do it on a sector. So if you found an exchange traded fund that tracks a sector, you can do the same thing. You can do this on an individual stock. It works across the board. And in this particular case, the first thing I'm going to do is focus on the resistance levels. And resistance means that the market reached it and it sold off. And in this case, I'm going to do this very long-term line where from my starting point, I'm attaching basically the tops. And just curiously, I just kind of added, I'm paying now attention to that 3,000 level, which is really interesting because you can kind of see right here, the market spent a lot of time around in here in 2017, 18, and then during the COVID crisis, we kind of spent some time around in there. So for whatever reason, that's an interesting place for this market. And so that's going to pay more attention in my mind. Then I'm going to look at this chart from a different kind of perspective, and I'm going to draw a line over this like shorter period of time of highs. And when I do that, I'm just looking for an area that maybe the long term and the intermediate term coincide, where they have some coincidental matter, like two angles colliding. And the reason I'm doing that is that just markets have a tendency to create behavior in certain areas, and they tend to be in the areas that we find that reversion to the mean. So by starting with this long-term picture, I'm just now kind of gauging a view, and I'm determining, okay, is this market overvalued or undervalued compared to that level of confluence? And right now I'm going to determine it's probably overvalued. And while I might be eager and might see some short-term opportunities, if I do deploy capital in this area, I'm going to do it in very small amounts. Because you have to remember, position sizing matters. And if you take on too big of a position here, and like we talked about, you lose 30% of your value, it's going to be really hard for you to have a high level of confidence to deploy more capital down here, because you're going to be freaking out about losses that you had. So it's real important.
Yeah, essentially, like my crypto purchase was at the peak of the peaks of peaks. So that was not smart. But it was such a little investment that, like, I learned my lesson. It was a pretty cheap lesson in comparison to lots of other people.
Hey, I did the same thing. I put $500 into one of these, this is going to be the next great things. And it went to, I think, $280, right? And so it lost 40% of its value, and very quickly. I'm glad it was a small amount, right? But even the guy like me who's done this forever, and even on that small amount, when it got to that 280, I wasn't all that interested in buying more, which I probably should have been thinking of that, because I had already taken on a loss, and your attitude becomes, well, wait, when it comes back a little bit more, I'll come back to it, So just avoid the losses
Yeah.
by being careful when you see a chart like this, regardless of what the asset is. So let's shrink it down. I mean, from there we go, okay, that's a long-term time frame. We can't live our whole life all about what's going to happen in 10 years because you may never even get there. So I always like to take the time frame and bring it down to a little more of a YOLO time and say, let's look at the last 5 years and shorter. And when we look at this asset over the last 5 years and we go through the same process, we connect all the highs with a line. So those are all the resistance areas. This time I'm going to connect all the lows, because somewhere in between that little fan is where I'm going to find a mean. And okay, there we go. So somewhere in the middle there, which is interesting because as I look at this chart, that middle line is an area that the market has really danced around. And so I'm going to watch if this asset declines, I'm going to watch the behavior in that area. I'm going to expect buyers to show up. But if buyers don't show up there, that's going to be a really big tell about the bigger attitude of the market. So you don't want to get too married on your perception of what you think is going to happen when you get to these lines. You want to use them as a point of, hey, asking the question is, what is the behavior at that time? And so now, so that's from a 5-year aspect, that just kind of gives you a better view. And then from there, I go, okay, so this is a rising trend, because obviously over the last 5 years, 6 years, 7 years, this is in a rising trend. So it's in a bull market. It might be a very mature bull market by the look of this, right? But nonetheless, the trend is up. So then I bring this down to a 1-year chart and I say, okay, if I'm going to get involved in this, knowing that it's extended, where's my levels of support? Because what used to be resistance, and what we mean by that is if something comes up and hits a level and sells off, hits a level and sells off, we would call that resistance. And we would wait for it to get above that and wait for it to start to test it as another area to maybe start to add capital. Because what was used to be resistance starts to become support. And that becomes another tell in the future that the more times that this thing dips and people buy here, that level of support's getting stronger. If that level of support breaks, then you go, okay, what's the next level? And you can continue to do that by looking at the chart, and it's a trained eye after a while, but essentially what you're looking for is any areas where the market declined, the energy stopped going down and went back up, because that tells you right there, there's more buyers than sellers. And it happened again here, and they tend to kind of repeat themselves. And then you can see after that second test, then you started to go higher. Same thing can happen when you run higher and you hit a level of resistance. You can decline, you go back up, and the first time you probably should expect it to kind of break down. And then when you see here, you get above that line, this is what we call a breakout. And so what you would want to be doing is if you have a breakout over a line of resistance that starts to become support, as it comes and tests, that's your areas that you can start to add to your position. Because if you want to manage your risk, that line, you could put a stop loss under here. So if you made a purchase there and you were trying to be really careful about managing your risk, then maybe you put a stop loss right under that level, assuming that if it breaks, you're probably headed back down to this next level of green. If this breaks, you'd look for another one down here. So
like I just learned about stop loss and take profit. And what I'm wondering is when you say stop loss, does that close out your trade? And if it does that, like, as long as you're still in the, I mean, like, as long as it's not going into your bank account and you close out a position, you don't have to pay taxes yet, right? It's only when you take your money from that and put it back into your bank account, or is it when you take a stop loss and close out a position, you get taxed?
very good question, and really important to understand. Part of it depends on the type of account you're using. If you're using an IRA, a retirement account, then don't lose any sleep over capital gains or capital losses, because in a retirement account, you only pay taxes when you withdraw money out. You take it out, you pay income tax. But while it's in the retirement account, you can buy and sell and not worry about capital gains tax. That's one of the advantages of a retirement account. In an individual, or what we call a non-qualified or a taxable account, you sell a position, you're now, while you have an account and you have positions, you're going to have realized and unrealized gains or losses. So what that means is if you bought something for $1 and it goes to $2 and you didn't sell it, you have a gain, but it's what they call an unrealized gain. The moment you sell it, now it becomes realized, it's a taxable event. And that happens, so if you, and what's real important, what happens to people that I saw this as a story on Robinhood, is that you have to watch what they call wash sales, which is, let's say you buy something for $1, you lose 20 cents. So now you got 80 cents and you stop out, you sell and you get out. And now you have a 20-cent loss. Well, if you don't buy that same investment again for 30 days, then you'll be able to use that loss to offset gains that you may have throughout the year as well. So you can help kind of balance it out. But if you buy that same asset again within 30 days, they call it a wash sale, and you won't be able to use that loss. And if you trade a lot, you overtrade, you can end up losing money and having a big tax bill. So your question is really good.
Like, when you say asset, does that mean stocks or bonds or whatever, or does it mean the company that you?
Any asset.
So like
a stock, a bond, a crypto.
Stop loss on my Dogecoin. I lost like 52%. I'm like, okay, the more I learn, the more stupid of an investment this was in the first place. Like, I'm going to stop and like take my loss and reinvest it into a different crypto. Does that mean I have to pay taxes on that stop? Or because I reinvested it within 30 days, I don't have to pay taxes on the loss because I'm still investing it in another asset.
Yeah, so in your situation, let's first go back and realize what you did with Doge was not an investment. It was a speculation, right? It was a bet. Hey, it's going to go up or go down. So that's one thing. And then, but more poignant to the question is that let's do the, like, if you put $100 in, you lost $50, you sold that position, you now have a $50 loss, or what we call realized loss. You go and buy another asset that's not Dogecoin, it's Bitcoin, or it's GameStop, or it's Palantir, or it's, Confidante Investor, whatever it is. You buy another investment that's not the same as what you sold, and let's say that makes $50. You can now sell that. Well, you had that $50 loss. You now have a $50 gain. They wash each other out. So you're not going to owe any taxes.
So
now
then I'm chilling. Okay.
You're chilling. The next $50 you make, then you may owe tax on that if you sell it.
If I sell it. Okay.
Yeah.
Okay, so here's another one. I bought Cardano and I wanted to transfer it to a wallet to stake it, to build like interest on it, right? But then I realized that the platform I was using would not allow me to send it to the wallet for Cardano.
Yeah.
So I had to close it out, transfer it to my bank, and then rebuy it on a different exchange.
Yeah.
Since I had to like close it out and put it into my bank, I had a
Yep.
small loss on it. Is this different
It's the
than
same. It's the same.
the
You
stop
now
loss?
have, yeah, you have a realized loss. When you have gains in the future, you'll be able to use that loss and wash out future gains. And that's something that's really important for everybody to understand, is all these different platforms and these different exchanges are very, very different. And some of them don't all carry the same coins. And everybody was running around going, oh my gosh, blockchain and this and that, it's going to be the wave of the future and it's put the old financial system to bed. And I jokingly go, yeah, but in the old financial system, you can still transfer assets through an ACAT system pretty smoothly and not get forced into selling things. And if this was the great new technology, why are they still forcing people to sell things, to go to a different platform, to the other, and that's part of the nascent early part of that industry that eventually will get worked out. But right now, be very careful. Do a lot of research on the app or the platform or the exchange that you decide to do your trading on.
This I have learned, and I will tell listeners, if you are playing with crypto, I was using eToro, which I thought, oh my God, it's bad because I can't transfer to a wallet from here. However, eToro actually allows you to have a stop loss and a take profit. But then I went to Coinbase because they connected to the wallet, but they don't have a stop loss or take profit or like much of anything. And now I'm like, well, shit, which one is like worth it, So
Yeah.
definitely look into the different parts of the exchanges that you're looking at.
And that should be part of your fundamental analysis. To bring it back full circle, is that part of that fundamental analysis is understanding that whether it's stocks or bonds or crypto, you're having to do this on an exchange. So at the end of the day, the exchange and the custodian are the people who are holding the money, transferring the money, moving it around. So they need to be very reputable. Now, in the stock market world, in the bond market world, the custodians and the exchanges have essentially been deputized by the regulators to really keep things straight. That's why it's a regulated market. You don't have that in crypto. You will someday, and that's probably the biggest threat to crypto volatility prices, is that someday, if they really want to get mass adoption, they're going to have to accept regulation. And that first wave is not going to be complementary to prices, most likely, I would think. It's a guess, but so keep that in mind.
That said, we look at Robinhood and GME or other, I think something that has changed in the past couple of years is these new exchange apps that are empowering retail investors to start doing things for free without a brokerage firm or without extra fees on these things. And we are learning the differerences when like Robinhood has gotten in trouble for like stopping people from buying a stock because they were like over liquidated or whatever.
Yeah.
And so there's more individuals that don't know what the fuck they're doing using apps that are trying to be this new thing, which I guess is kind of similar to cannabis. And it's like you do not need to reinvent the wheel because the wheel works really well. So it's like, there's so many new exchanges coming, and it is important, even if it's not crypto, if it's stocks, to pay attention to like what the pluses and negatives are and to do research because the newer things have had issues.
You always follow the money and figure out where people make their money, or exchanges make their money, or custodians, how do they make their money? And the reason I say that is I'm very concerned that there's this new wave of business and finance. And there's this new terminology running around about democratizing, right? Oh, we're democratizing it. We're making it simpler for the little guy. Oh, really? Really? I mean, at the end of the day, you're a business. You're about making friggin' money. So don't tell me that you're trying to do some great thing in democratizing things and then hide how you're making money. That really is offensive to my nature, because I feel like, hey, if you're going to tell me you're democratizing things, then you're putting my guard down because I feel like I can trust you, that you're on my side. But then on the back end, you're not going to be transparent with me. I got a problem with that.
Yeah, when we first started this podcast, you had said something about like, be wary of anything that's free because they're making their money somehow. And I think just in the like month or so that we've been recording, this plays out in these different new exchanges that are like no broker fees, but we might prevent you from being able to trade or sell off or not notify you when there's a big market change or whatever, and you end up paying in a different way that you didn't expect. So, but let's do this in two parts. So we will come back on the next episode and finish this part because I think this is so far the most like important. Once you get through everything and you start wanting to trade, you've got to understand fundamental and technical analysis because this is math and human nature. And like both of them are complex and both of them can really screw you or like change your life in a super positive way. So
and this is how we pick the names. This is how we pick the investments that need to go into the portfolio. So that'll be good for the next portion. Yeah.
Okay, so stay tuned for the next episode as we continue our technical analysis deep dive.
Take care, everybody.
Thanks for watching. Make sure to subscribe and like. And make sure to watch episode 8. Kristen prepares to go live. In episode 8, Kristen and Colby begin the last steps before Kristen begins investing with real money. It's a must-see as season 1 wraps up. Visit confidanteinvestor.com or YouTube to watch now.